Welcome back to Be Great Economics. I'm Nate. Let's get started. Today we're going to be going over Keynesian economics model, and I'm just going to give you the simplest equation possible to make this make sense. And once you understand this base equation, you can start to make sense of where some of the moves going to go. But some of the base problems you're going to realize calculating what each portion of the equation is way more complicated, and it gets into that conversation of what's the difference between complication and complexity. So complication being you'll open up a watch, you look inside the watch and you go, I don't know what this is, but somebody can tell you, a watchmaker can. Meanwhile, complexity is where you open up the back of the watch and it's silver goop and no one can explain to you exactly what's happening, but we know that it's functioning. So it has an end result that does function, but we just can't explain every single bit of the difficulties within it yet. So John Maynard Keynes and his base case written in 1930 for a treatise on money was the idea that we should expand or contract the money supply as well as utilizing the interest rates to set that. Now, he was against the gold standard. I'm just going to give top bullet points. He was against the gold standard. In 1925, he argued with the British central bank, saying that they should go back to a gold. If they're going to go back to a gold standard, then they should go to 35 pounds an ounce. The reason why was because the money supply had been increased against the gold, and they didn't, and they went to 20 pounds, and so it caused a lot of distortions in the real economy. So he was very much correct in saying that if you're going to go back to a gold standard, at least do it correctly. They made mistakes on both sides there. He believed that investment determined employment, and he lays this out in his thesis on Treatise on Money, saying that if you have an increase in investment over savings, then you're increasing the productivity of a society, and so you're going to employ more people with investment. This is starting small businesses or investing into stocks that allow them to leverage the risk that you're taking in order to speculate on hiring more people for projects. So obviously the general concept of the statement is relatively valid. And then he advocated more than bank lending rate incentives. So he wanted to see that expansion and contraction of money supply to affect it. Here's the base equation. So it's S versus I, M versus L, AGS versus AGD. What is this? These are all just abbreviations. And so simplifying this equation, it goes down to savings, investment, money supply, liabilities, aggregate supply, aggregate demand. So if savings is equal to investment and money supply can service or equal to liabilities and aggregate supply is equated to aggregate demand, meaning they're meeting, you should have stable prices, stable employment. You will generally have a stable economy. That is the core thesis. That's it. It's that simple of an equation. Savings and investment, money and liabilities, aggregate supply, aggregate demand. Now, there's some complications that need to be talked about that I will expand upon each one of these pieces in later videos and how it's hard to calculate. And so you're taking risk whenever you're trying to make a guess on where the probabilities lie. And you could probably read his book on a treatise on probability in 1925. That one's a pretty good one too. I'm still getting through that one. But so where do we sit today? And this is where the argument comes down to. What does the equation look like for current America and the global economy, as America is highly globalized and our currency is a global currency? Theoretically, based off the current choices being made by the Federal Reserve and banks, the belief is we have supply is less than, or sorry, savings is less than investment, right? And we know this from data from the Bank of America. We can find that savings went up in 2020 and then just continued on a downtrend. We're almost back to, or we are back to right where we were right before the 2020 events. So savings is less than investment. We know this, investments have gone up. Money supply is potentially greater than liabilities. This is a very controversial conversation because people think that the money supply is increasing, but there's a lot of data that shows alternative views. And so the argument here is that M2 has increased and therefore the liabilities are not keeping up. But we also have debt to GDP being very high. So is it where these liabilities lie? And I have an argument about how investment is both asset and a liability as being a potential promise on future money. And so this can become very, very complicated topic. That might be like a 45-minute video on how the money supply and liabilities are not in balance, or that the money supply is not exceeding liabilities. But the belief and choices being made are we need to taper, so reduce the money supply. Now, aggregate supply and aggregate demand, we know that supply is less than the aggregate demand because we have high demand. That is both due to the money supply and the events that have caused supply to be removed from availability. So you have an increase in the demand and a decrease in supply. So you have a huge distortion there, which is causing even more price increases. So what's the end result of this equation? We should have price inflation with potential for a wage price spiral or further inflation. So the price inflation is coming from the aggregate supply and aggregate demand being out of balance. Supply being lower than demand. But the problem with the wage price spiral that occurs is that savings are low, investment is high, meaning investments have gone up, so those who are not invested are losing out. The money supply is increasing, and the liabilities are theoretically decreasing, and so you're going to get a continuation of this. There's a potential here for more momentum towards the liability side, which can send you into a wage price spiral as we try to increase wages to increase productivity to meet this demand. So it goes further and further, and you're gonna keep increasing the money supply until the liabilities outweigh it, and then you end up at a default risk, and then you start a deflationary spiral. So the current risk or current economy based off of this potential side of the equation is that you expect both price inflation to exist and to continue into a wage price spiral. We theoretically haven't entered that spiral yet, but we could be if this equation continues to play out. So the argument is reduce the money supply. Now, the alternative argument, all I did is flip that carrot, right? Money supply is less than liabilities. If you're wrong, if the money supply is not outweighing liabilities, in that, what if, based off the Eurodollar curve, based off of the bond yield curve, based off of the current creation of money supply, that liabilities has increased as people speculate too far. Liabilities has increased, but the money supply is not keeping up with the liability increase. Now you get to that question, rock and a hard place, that the Fed is stuck. That is why people are saying it. And this helps lay out that equation. If they're wrong, and this is the equation, which I think most people that say that the Fed is stuck see that this is the equation. The money supply is less than the liabilities, which means that you have price inflation because of the aggregate supply, aggregate demand, savings, investment, with the potential for a deflationary spiral because you're going to push the demand and supply to catch up. And once it does, you're going to have drop in the sold asset prices or the sold inventory, which is then going to drop it's going to drop the investment value, which makes it more of a liability, which also makes defaulting on bonds denominated in dollars to go down. And if you're wrong about the money supply, huge issue. Now, that's just to lay out the equation and then the two arguments to this. And there's way more complexities into each of these, which is why I'm going to do a video on every single one of these pieces on, how can we try to identify this? What are some of the indicators I like to use? Where can I find some of the evidence for this? And you'll see that there's kind of two sides to each story, and so it's hard to lay out exactly where it is, and you're trying to make an assessment based off the data in front of you, and you may place more value on one piece of data that is factually accurate, but may not have as big of an effect as you think it does. So our hopes are that the Federal Reserve, with all of its economists and all of its brilliant minds, located in one central organization, decentralized across the US, and discussing and arguing in a room, have determined that money supply is theoretically greater than liabilities, and they need to reduce that in order to equal out this equation. But you can see that there's arguments for why they're wrong. So thanks for watching. I'm going to give myself an A+ for starting this because I can't find one video on YouTube that covers this equation, and in fact it's hard to find this as an equation rather than a word discussion. And so I think presenting as an equation makes it easier to have a discussion about how is this balancing out and where are we going. So thanks for watching. I'll see you all next time. Click like and subscribe.